So the first thing we're going to do on this spread on the SPX is to analyze or simulate price movement. So price, as we know, is out of the three factors, price, volatility and time decay, price is probably going to have the maximum impact on your options position, and this is for any options position. Of course, we're not talking about very special situations like if the option is expiring tomorrow or perhaps there's earnings coming out in the next couple of days. In that case, the volatility will be pumped up. So we're not talking about any extraordinary situations like that. In a regular situation, price movement is going to have the maximum impact on your position more than time decay and more than volatility changes. So let's first look at price simulation and try to understand what will happen to our position if something happens with the price or if certain things happen with the price. So the Thinkorswim platform provides you various tools to simulate price, and I'm sure all the other platforms also provide you some of these tools. So the first thing you see here, you have a plus 10%, you have a live row, and then you have a minus 10%. So these are basically, it's a simulation, a price simulation. So it tells you, 1353 is the current SPX price. So the plus 10% tells you what will happen to your position if the S&P 500 goes up 10%. So it will be going from 1353 to 1488. Now that's a huge jump. I don't think, simulating something like plus 10% is going to be very helpful. So let's change the percentage to plus 5%. Now you can see there are various percentages available to you to simulate your price. So let's go take plus 5% and minus 5%. So that's a reasonable way to simulate your price movement. So when you're simulating the price movement like we are doing now, you're basically keeping time constant and you're keeping volatility constant. So it's like you have three of these instruments on your instrument panel and you're freezing two of them and you're only tweaking one of them, and that's the price. We are saying that if it goes down 5%, then this is where the S&P will be on the left dotted line, and if it goes up 5%, this is where we will be. And then these two rows tell you exactly what your profit and loss is going to be. So if we go up 5%, this is what our P&L will be. It'll be $1,800. If it goes down 5%, this is what our loss will be. We'll be down $3,500. So why is this happening? Why is this double than this? Well, that's because we have more risk on the downside. And these losses are only on paper. Bear in mind, even if it goes 5% down, that's at a strike price of that's at a price of $12.85. Our short strike is at $12.60, and then we even have this much room which we got from our premium. So it's approximately $12.57. So that's where on the day of expiry, we'll see losses at that point, $12.57. But just because your break even is at $12.57, are you going to just keep quiet and do nothing if it comes down to $12.85? No,